All right, folks, sorry for all the delays and everything else. Just kind of getting things back online here. I appreciate everybody coming to check me out. What's up, Greg? I love your stuff. All you other guys, thanks for watching. Yeah, things have changed a little bit, and I switched from YouTube to Twitch for a while, and it's a totally different OBS setup and everything. So we're going to have to get back to normal here for a second. But as I was saying before I was so interrupted, some of you might wonder where VIX crush comes from. Well, back a few years ago, I was very upset over quarterback Michael Vick's and his use of dogs, attack dogs, and them fighting. And thus, I made a channel about that and how that was just the wrong thing to do. And that's when VIX Crush was started. I wanted to crush Michael Vick's use of dogs. And then slowly there was a financial angle to it, and it became the VIX Crush channel on YouTube. All right, so today, here we are. And of course, the day that I come back online is the day that the volatility kind of spikes. But this is kind of to be expected. We've had such a calm run. We finally had a pop after all this calm stuff. Let's take a quick look at the charts here. And as I try to get my situation moving here, let's see what we've got. Let's go to the charts. Now, we have the E-minis and S&P down quite a bit today on the open. Like I said, this isn't a surprise to anybody who has been following the market. We've been calling for some sort of pop for a long time now, and we finally got a little bit today. However, if we do take a look quickly at the E-mini charts, you're going to see that it's not like we're in the middle of a sell-off. I mean, we have a long way to go if we're actually going to have any sort of sell-off. You know, all this talk of recession, the chart looks pretty bullish to me right now. I don't know what you folks think. Yeah, if we close in on today, then yeah, we've had a down move today. But maybe this is the start of something, a down move, but we really are in this just huge rally right now. Despite there's some doom and gloom people out there. I had somebody email me something a couple days ago saying, Dave, did you see this? This guy made a, $2 billion bet that we're going to go lower from here. And, there's always people making bets that we're going to go lower from here. And when we finally do go lower, people come out of the woodwork saying, I told you so. But in the meantime, the quickest way to separate yourself from your money is to try to pick the top in a market. And I think most people would agree with me on that one, because the tendency is to rally, and we're in an uptrend. We've been in an uptrend for a while. And yeah, you can try to pick the top, which the inverse of picking the top, or a surrogate for picking the top, is getting long the VIX, or getting long a TVIX, or a VXX, or a UVXY. Now, if you go on the StockTwits for UVXY today, you're going to see all these people saying, oh, wow, this is a great thing. I made $1 zillion because I was long these calls, or I made $1 zillion because I was long these SPX puts. But guess what? If you'd done that 9 times out of 10, you would have gotten your rear end handed to you. So, yeah. Channels on YouTube that talk about doom and gloom and how this is going to be the crash, those channels get way more views than a channel that takes a stance that I take, which is the most likely thing is we're probably going to slowly rally from here. That's not exciting. It's not sexy. What's sexy is to say, have a graphic of a big tidal wave that's just about to roll over us and say that it's the end of the world. And I had somebody come on to debate me on this about a year ago, and it was somebody who was new to the markets, new to charting, new to everything, and basically came on and garnered this huge following and really exploded on YouTube started out smaller than me, became way bigger than me on YouTube, and talking about this, how like, oh, well, all the stars line up that we're going to crash. And then last December, when we actually did go down, this person was like patting themselves on the back like they're a genius. And but then all of a sudden we rallied again and we're back up. This move down here, this was around the time I interviewed this person. Let me get out of the way here. This is the time I interviewed this person, was like in, I think it was like over here in like October of 2018. And they're like, oh yeah, it's the end of the world, it's going to crash. And, you know, we cruise lower. And they were like, yep, I'm right. And I guarantee, even at the bottom here, they were like, oh, it's the end of the world, doom and gloom, let's live off the grid, all this stuff. But then guess what? Boom, we rally back. And those of us, I will say I got lucky and I bought the bottom here a little bit. But, you know, we came back and we continued to rally. And that's what seems to happen every time, is we continue to rally. So don't be put off by somebody who says they picked the top today and this is the beginning of things to come and they made $1 zillion on their SPX puts, because the most likely thing is that someone buys the dip here and we kind of come back. Now, we haven't even gone down a lot to come back from, really. I mean, look at this. To go down to come back from, we'd need to go through like maybe like 2,900 or something. I mean, we haven't even gotten through 3,100 yet. So don't read too much into this move, I would say. Now, the VIX, let's talk about the VIX. Well, VIX has gotten down kind of low lately. I wouldn't say to historic lows, because it's not historic lows. Historic lows would be like at least through the 10 strike. I don't even know if we've gotten through the 11 strike. Let's take a quick look at the VIX here. And if just looking at this chart here, you can see that, yeah, it's like we were at a lower level, but we haven't busted through the 11 strike, and we haven't gotten anywhere near levels that were in 2018 down here, where we had that all-time low of 856. We're in a mid-range right now, so we get a pop here. It's not necessarily the time to like load up the boat. In fact, as we creep up here, we're right now at 1433. As we creep up here, the higher we kind of creep up, the less of a real bang you're going to get out of the VIX here, because the more we creep up, the less of a coiled spring it is. You know, if we could have gotten down to like 10, it was more of a coiled spring. But look, they're not letting this sort of coiled spring effect happen. People still remember very well the Volmageddon of February 2018. The people that are trading futures now remember that, and you see the futures are quite a bit higher than the VIX. Of course, today the VIX has rushed up to reach the front month future, and it actually surpassed the front month future for a little while, but that is back over with, and now there is about 50 to 60 cents between the VIX spot and the front month future. So we are still in a steep contango shape, folks. Make no mistake about it. The contango shape is intact here, and that means that there's not really all that much fear going on right now. It also means that there is a huge amount of shock absorber in this VIX here, and so we get another big, we can get a spike that is the same as we got today, another 2 points, and these products are still going to not perform very well. I mean, VIX up 2 points, so percentage-wise, what is that? My screen shows me VIX up 15%, and you've got VXX up 78 cents. You've got TVIX up, I think, $1 now. Let's see, TVIX. So you've got the VIX up like 15%. Well, TVIX, the percent's not going to tell me because it split. It just split. But it looks like, actually, I'm sorry, TVIX is up $8 from the open today, but that is post-split. So So not doing too bad, TVIX, 10%. Remember, TVIX is 2 times leverage, so you're going to get more bang out of it. But UVXY up $1, so up 6% with the VIX up 15%. So this is a 1.5 times leverage product, right? So if somebody was just interpreting this just by looking at the VIX, they'd say, VIX up 15%. Why is this only up 6%? Well, that's because the term structure. Remember, UVXY is not based on the VIX. It's based on VIX futures. And the front month future is currently up 6%, right? The second month future, UVXY is based on a mixture of the first month and second month future. Second month future, only up 3%. So you've got a one future up 6 and change and one future up 3 and change with the VIX up 15%. Why are these futures not up even half what the VIX is? Well, that's because there is so much room and shock absorbing. I like to call it the shock absorber. There's so much room in the term structure to absorb an up move because the futures are lined up in such a way to anticipate this up move. So these things are just going to underperform to the upside. Yeah, you made money if you were long TVIX today, but you didn't make nearly as much as you quote unquote should have, or as much as the VIX would justify. A VIX up 15%, in some people's mind, that should mean TVIX should be up 30% because it's a 2 times leveraged product. But because of the way the term structure is right now, TVIX is not up as much at all. It opened 60, it's up $8. So do the math on that. It's going to be, once again, a little bit confusing for people because TVIX split over the weekend. So you're going to see it saying it's up like 900% or something. And people are going to get a little bit confused over that. Okay, TVIX split 10 for 1 over the weekend. So it went from $6 to $60. So you're going to see you can see the pop here. And thus the math here is all screwy. But yeah, the stuff underperforming. Now, the contango is not predictive, thus meaning that the shape of contango doesn't tell us which way the market's going to go, but the term structure that we are in right now is acting like a huge shock absorber, and thus anybody who tries to capture that volatility by getting long these VIX ETPs is going to be disappointed in the move in them today. Now, if we had several days, if we have 3 or 4 days in a row of the VIX up 2 points, that shock absorber, that elasticity of the shock absorber is going to disappear. But just one down day like this is going to be absorbed by the term structure. Let's take a look quickly at the term structure here because it has flattened out a little bit. If we look here, we can see, all right, so contango 12.78%. All right, so contango was 16% coming into the weekend, so it's down a couple percentage points. And the real noticeable difference, though, here is you see spot and the front month future now showing only 20 cents away from each other. This relationship was inverted, and that is where instead of the move, what's happened here is that the spot has moved up, and that could be reacted to by the term structure in a couple different ways. One way is that the relationship between M1 and M2 could flatten out. That hasn't happened at all. What has happened is just the futures really haven't moved that much, and the spot has rushed up to meet the futures. This was over 2 points wide, and now it's almost right next to each other, the distance between spot and the M1 future, the roll, so-called roll yield. Now, I would bring you back to Eli Mintz's famous quote that contango losses are forever. So as long as this contango number stays high, and we want to look at the second month too, just to see how this chart moves outward. But as long as this contango number stays high, the long-term decay of these products is still intact, and that as we rebalance with this high contango number, that value is lost forever. The value that we lose of the front month future going up and down as spot goes up and down, that can kind of come back. You know, we if we're short, we lose money as this goes up, but if spot goes back down again, this future goes back down again, that money will come right back into our accounts. However, if you're long this stuff and it keeps rebalancing with this 12%, that is going to, over time, decay these products inevitably. Now, for me, as I have a long-term trade on right now, and so having this VIX pop, it's meaningless to me. As long as this contango number stays intact, this stuff will continue to decay. And yeah, the VIX will move up and down a little bit, but this stuff will continue to decay. I'd much rather have it like this, where the contango number stays high and there's not that much room between spot and the front month future, than to have this curve flatten out and there still be room between spot and the future. I'm not sure if I'm quite explaining this the right way, but essentially, as this spot moves up, one of two things can happen. Either the futures can all move up and maintain their shape, or the futures can pivot where the front month moves up more than the second month. And they've pivoted a little bit. The front month has moved up a little bit more than the second month, but not that much. Let me get my little pen out and mark this up just a little bit to try to explain this here. So we've got our term structure here. So when the VIX moves up, when spot, this is spot down here, when the spot moves up, what's happening right now is pretty much this whole shape is moving up all together, right? As opposed to, which is better for long-term decay than if this just, it could be that this front month future was just pivoting on this hinge here of the second month future. If it was pivoting up like this, that would be worse for us because the contango, that would be worse for the people that are short this long term, because the contango percent would go lower. And contango percent, as it rebalances, is value that's lost forever, and you just don't get back. I mean, the only way you would get any of that back is if we were going into extended backwardation. And we can only go into backwardation for so long before the market actually is at zero. So this staying at 12%, regardless, for me being a long-term short, regardless of what price the VIX cash is at, as long as this contango number stays constant, I know that this stuff is decaying before our eyes. So this stays intact. Now, like I said, if we get a few days of down moves in a row, you will see this whole situation dissolve pretty quickly. In fact, you'll see spot go above the price of the futures, and you'll see all this stuff flatten out. But the reason we have this high level of contango here and it's staying in place is just because we've had weeks and weeks and weeks of rallies. And that weeks and weeks of rallies builds up in this term structure here. It's almost like you're putting money in the bank for a spike. And as contango builds and builds and builds, you're putting more and more money in the bank. And the other point I wanted to make is that if you go in and buy TVIX right now, you aren't buying a 14 in the VIX. Actually, you kind of are. You're buying a 14.9 future and part of a 16.8 future. So, if you'd bought TVIX before the weekend when the VIX was 12, you weren't buying a 12. You were buying a 14, and now after that $2 spike, you're still only buying a 14.9 in the VIX. But buying TVIX today at the prices it's at now is closer to buying the actual price of the VIX, a lot closer than it was on Friday, because the distance between spot and the futures is much closer right now. So we'll have to see what happens moving forward with that particular thing. Now, I wanted to, since I'm back on the air and I've been off for a while, I wanted to go through just a couple strategies of shorting volatility and how people go about shorting the VIX. Because some people might consider this pop an opportunity to short this stuff. Now, let me just re-emphasize once again that we don't have a big sell-off, and this isn't a big pop here. A big pop would be VIX over 20. This could just be, right now, could be the beginning of something. So don't bet the farm on the short side just because we popped 2 points here, because 14.75 could be considered a mid to low range still in the VIX. So might not be a spot that you want to lay into selling it. However, it's a better spot than we were in on Friday, and it might be a spot to initiate a position, because if we return to where we were Friday, in the next week, then it would be a good deal for you. But there are several ways that we short volatility. And the first one I'm going to go through them really quickly, and we're going to go to UVXY. And the first one is what we refer to as the bullseye position. And for this one, you would want to have the ability to sell naked options, and this is a higher risk situation. However, if you know what the risk is, then you can decide if you want to do it or not. And this bullseye position, you are selling naked calls. And each call you sell, you should think of as shorting 100 shares of UVXY. So if you sell one call, you're short 100 shares. So each dollar that UVXY goes up, you lose $100. If UVXY spikes to 100, if UVXY spikes up $10, you're going to lose 1,000. If UVXY spikes up to 100, you're going to lose 10,000. So you want to think in your head for each call you sell in this strategy. You want to imagine what will happen if UVXY goes to 100. We always want to look at the worst case scenario when we're trading, because then we won't be caught off guard. So can you manage being short 100 shares of this, and with this going to 100? If you can't, then you don't want to do this. And each call you sell is shorting 100 shares. That's the worst case scenario for it. It's most likely nothing's going to happen, but you want to be prepared for the worst case scenario. So the bullseye strategy would be to take the at the money call and sell one of them. So here, UVXY at the money call, the 16 call, you could sell one at 80 cents. When we talk about selling and buying things, my background is as a floor trader, so I'm very careful to say things in the proper way, because a lot of times I was giving orders to people over the phone. And people over the phone, when you give an order, they're going to want a initiating thing you say and a confirmation of that. What do I mean by that? Well, you're going to say, I want to sell. That's the initiating thing, so they know which side of the trade it is. You're going to sell, then you're going to give the quantity, then you're going to say at, because at means sell. So they're going to hear, I want to sell one, in this case, December 16 call at 82 cents. Now, this way, if somebody hears your order, they're going to know this person really wants to sell it, because they've said sell twice. I want to sell it at, if I wanted to buy a call back, I would say, buy me one UVXY December 16 call, pay. So they're going to say, you're going to hear buy, pay. So this is something that you can use if you with people on StockTwits or something, because you hear people on StockTwits say all the time, I'm going to buy a call, or I bought a call at 50 cents. To a professional trader, that doesn't make sense, because when you say I'm going to buy a call at 50 cents, when you buy something, it's not at. At means sell. So if you gave a phone order saying, buy me a call at 50 cents, the phone clerk would come back to you and say, what do you mean buy at? That doesn't make sense. When you buy something, you pay for it. When you sell something, it's at. And when people mix that up, you know that they're not professional traders, because no professional trader would say, buy that at 50 cents or buy that at 80 cents. So anyway, if we had sold the call on the market 5 minutes ago, we'd already be making money because the market was 80 bid at 82. So the bullseye position would be to sell an at-the-money call in UVXY in the front week. Now, why is that a good position? I just told you that, the worst case scenario is pretty bad. I mean, if this went up $100, you lose 10 grand, and all you're making, the most you can make on a call that you sell for 80 cents is 80 cents or $80 per contract. So you're risking $10,000 to make $80. Yeah, this is a capital intensive trade, and it has a certain amount of risk. However, the likelihood that it goes to 100 is very low, but there is that risk out there. But the beautiful thing about this bullseye trade is that you are taking advantage of several things at the same time. You're taking advantage, you're picking the option that is decaying the most rapidly on the board. It's a front week call at the money. That is decaying very rapidly every day. So you're taking advantage of that 12% contango that we just talked about, which is decaying these products very rapidly, and the most rapidly decaying option on the board. And the combination of those two things creates a beautiful situation, because you're not actually shorting shares of the stock. What you're doing is you're selling an option that's decaying more rapidly than the stock. So and by stock, that's just a shorthand for this. I know it's an ETF or ETP. But by selling one of these at-the-money calls, we're doing better than selling the stock, because even if UVXY stays where it is, this option will still continue to decay. You're essentially selling the stock plus whatever you sold the option for, and that extra amount of money is just money in your pocket. Over the course of only 4 days, that whole $80 is going to go to zero with UVXY right here or lower. In fact, now that it's down 10 cents, you've got 10 cents running room to the upside, so it can go up 10 cents, it can stay where it is, or it can go lower, and you're going to collect that $80 for each call you sell. So this bullseye position is beautiful. And what happens if UVXY on expiration day is higher than 16? Well, what you do is you take this call and you roll it out. You buy back the one you sold and you sell the one for the next week out, which would be this one here, the 13 December call. Right now it's trading 117, but by the end of the week, it will be a different price, of course. But this bullseye position is a beautiful position. It's a beautiful thing because it takes advantage of several things and compounds them to give you amazing returns. However, it is a risky position, and it's not one that somebody who's brand new to options wants to do, because we don't suggest that someone who's brand new to options sells naked options, because the main reason is that we're just not confident that people understand exactly what they're risking here. And I know people get excited and might put on too much risk. So what we do suggest for people who are just starting out is to put on a limited risk trade. And a limited risk trade would be to put on a call spread. So you're selling one call and you're buying a higher up call. So what this does is it stops you out in a way. So if I were to sell this 16 level call, but then I were to buy a 20 level call against it, well, I'm reducing the amount of money I can make on the trade, but I know that I'm stopped out if this thing goes up to 20. My losses stop at 20 when this gets to 20, as opposed to it possibly going to 100 or something if there's a huge spike. So, and even for experienced traders, a lot of times a defined risk trade can be the best type of trade, because you can actually use your buying power more efficiently with this sort of trade. If you sell a naked call, you really do need to put aside cash for that possibility of a huge spike. However, if we were to do a limited risk spread trade, by nature of the fact that it's limited risk, we can put on more size and feel comfortable about it. So, for example here, I might feel only comfortable selling one or two of these at the money calls, the bullseye trade. However, I might feel comfortable putting on 10 or 20 spreads, which, in the course of the week could make me more money than just selling 1 or 2 calls. And so a possible spread trade would be to sell an out-of-the-money call spread. So, for example, and if I were going to do a limited risk selling a call spread or buying a put spread, what I would do is I wouldn't do it in the front week. The reason we do the bullseye spread in the front week is because that's the most decay intensive option. However, if we're going to do a spread trade to short volatility, we want to move it out a few weeks or several weeks, thus giving us time in case we get a spike. Because if volatility spikes, and we have this sort of trade on, we want time for stuff to come back into line. Usually a spike only lasts 24, 48 hours. We've seen them last up to 6 months, but the average spike only lasts 24, 48 hours. It can last less than an hour even at times, but we want to give ourselves a chance to recover from a spike if we're putting a spread trade on. So I would generally move out to between 40 and 60 days. Now, when I look at UVXY here, I can see our choices are either February, which is 81 days away, January, 46 days away. And so I would probably move out to February at this point if I was trading spreads in UVXY. And right now, I'm happier trading spreads in VXX and UVXY because UVXY the markets have been very wide, and it's really annoying dealing with the market makers and dealing with the way these markets move around. Like your position can get marked against you where you know that you've put it on for good prices, but it shows you losing money for days at a time. And when you try to get out of the trade, it can be hard to get out of. So I tend to want to look more to VXX for spread trade. So let's look at a VXX spread trade really quick. I'm going a little longer than I want to here, so let me kind of speed up here. Let's look at a VXX trade that I would like to short volatility here if, we've had a little spike. Maybe you want to take advantage of it and jump on the short vol train here. So which spread might I look at right now? Well, I might go out to February and look at some sort of at-the-money spread. So, for example, what about the February 2017 put spread? So this trade, you're going to have the maximum results if if VXX is 17 or below in 80 days. So right now VXX is 1734. It's certainly reasonable that due to contango and mostly contango, that this will decay. Right now, with contango at like 12%, this is decaying by like over a point per month. So if we go out 80 days, even if the VIX is considerably higher than here, even if the VIX is 17 or 18, we can calculate that this should be below 17 in 80 days. So we might want to look to put a trade on, and I would suggest if you're just starting out that you put higher probability trades on. We might look to maybe put on the 2017 put spread. So let's queue up this trade. So what I'm going to go into right now, I've got Thinkorswim up. So I might go in here. And I've got my option screen over here. In the middle here is the strikes. And if you know this already and this is too basic for you, just hang with me for a second because I just want to explain this to people who might not have seen this that much before. Here, this line has the strike. So these are different possible prices for the stock, otherwise known as strike prices. On the left side, we've got the call market. So you can see that, for example, this February 19 call, the bid is 191, the offer is 194. On the right, we've got put prices. So to buy a put spread, we're going to buy the 20 put. So we're going to look to the offer of the 20 put, which it says 440 is the offer. And then we're going to look to the bid for the 17 put. So I'm going to go over to the offer of the 20 put. Then I'm going to hold my control button, click on the bid of the 17 put, and that's going to queue up this ticket here. And now we can see this is a ticket to buy one of the Feb 20 puts and sell one of the Feb 17 puts. This is a $3 spread. The reason I can tell that is if I subtract the higher strike from the lower, I get $3. 20 minus 17 is 3. So the most the spread can be worth is $3. Another way of looking at that is if VXX is 17 or lower on expiration, this spread will be worth $3. So to figure out how much I could make on the spread, I'm going to look at the price that it's trading now. This price here is the midpoint. So this is kind of like the optimal price. This is like the average in between the bid and the offer. So we don't know if we can get this price or not. It would be nice if we got this price. If the marketplace is acting efficiently right now, then you could call this price the value of it. What the market is valuing the spread at right now. Right now, it just switched from 215 to 213. But the way to look at this is, okay, well, we could buy this for around 215 right now, and it can be, and we know by subtracting the strikes that it could be worth $3 at the most. So we stand to make the difference between $3 and 214 if we put the spread on and VXX is 17 or below on expiration. We're going to pay commissions on this. Commissions are usually a penny. You can think of it as a penny. It could be less for a lot of people, but you can think of it as, when this shows 214 here, you can think of it as, well, if I'm paying 214 for it here, I'm probably paying 1 penny to put this on and maybe 1 penny to take it off. So think of commissions that way. It's not very much, but it's something to consider. Now, I'll use a lot of times, this has generated this ticket, but if we press confirm and send, it's not actually going to make the trade happen right now. But what it is going to do is it's going to give us some more information. We can do the math ourselves, and I can encourage you always do the math yourself. But just as a little cheat sheet here, let me move this over a little bit. If we hit confirm and send, it's going to start to do the math for us here. And if we look at this screen, it's going to show us maximum profit, $86. Where does that come from? Well, the $3 that the spread could be worth minus what we potentially could pay for it, which would be $214 equals $86. So a way of looking at this trade is we're risking a little over $200 to try to make a little over $80. So it sounds like, decent money percentage-wise. When we talk about the best traders in the world make, a really good year for a really good trader would be to make 40% on the year. A lot of times when people are starting out, they assume that they're going to be the best trader in the world, and they take these huge risks. But this would be a really good return if this were to work out for us. Betting $200 and making 86 on that money is really putting that money to work for you. If you were to size it up, you could say $2,000 to make $800. That sounds pretty good. $20,000 makes $8,000. That sounds pretty good. I mean, any business that had this rate of return would be doing really well. And it seems reasonable to me to expect that VXX is likely to be lower than 17 in 80 days. Especially with contango over 10% here. Even if contango cut in half to 5 or 6%, it still would be reasonable that this would be less than 17 in 80 days. And the other thing about a trade like this is that we could take this trade off or roll it into something else at any time. It's not like if we execute this trade, we've just put it on and then it's all over and we just wait out the 80 days and see what happens. No, we can adjust over time as market conditions change for us. So this is a trade I would recommend as a way to start shorting volatility. Now, we could look at something even more conservative here really quickly. So let's do that. Let's go up a couple strikes. So instead of looking at that, let's go over to the call spread. Now, to me, call spreads and put spreads are the same thing. And this is not intuitive to a lot of people online. And it's something that a lot of people don't get for whatever reason. I know people have a hard time, a lot of people online have a hard time getting the concept of shorting a stock, selling something that you don't own. And it can take a little while to get that. The other thing people don't get is that call spreads and put spreads are essentially the same thing. Let me say that one more time. Call spreads and put spreads are essentially the same thing. So to prove that to you, let's take this example here where we're buying the 20 put and selling the 17. Okay, so we're looking at buying this put spread paying $2.15, right? Well, that if we take $2.15 and let's queue up that second screen, 85, right? Buying a call spread, buying a put spread is exactly like selling a call spread. It's just upside down. This $2.15 that we're paying here is the same thing as if we sold the exact same call spread for $85. It's the same thing as far as how much capital it takes. You might say, oh, well, selling the call spread takes less capital. But no, they're going to make you put up the capital as if you'd paid $2.15 for the put spread. So, and I can prove it to you here. Let's go over and see where that call spread is trading, that same one, the Feb 1720 call spread. I sell the 17 call, hold control, and buy the 20. Okay, so the call spread's 84 cents. So very similar price. And look, resulting buying power effect for selling the call spread, negative 217. Let's look at the buying power effect for buying the put spread. Negative 215. It's the same thing, folks. And people try to get into these debates with me. Oh, well, no, the call spread means this, and the put spread, no, and it means that. And it's the same thing, folks. Now, if you want to get into, you can get into some nitty-gritty of assignment risk. If you have a stock which has a big dividend, and if you're dealing with deep calls, then there's an assignment risk to do with the call spread versus the put spread. If you've got a situation where you're dealing with very, very deep puts and you're selling a very, very high premium put, then you've got assignment risk on those puts, because if you're somebody who owns a put that is like a $42 put and the call is worthless, you probably rather just exercise your put, because you've got to borrow that money to own that. When we think about interest for options and stocks, we consider any money that we have to put up for a trade, we consider it as money we have to borrow from somebody. So we look at the interest rate it costs us to have that money sunk into an expensive option. So yeah, there's some differences when you're talking about really deep options and premiums and options that could be assigned. But beyond that, when you're looking at sort of at the money call and put spreads, they relate to each other, and I basically consider them the same thing. In this case, we can look at them and we can see where's the open interest. Well, if there's more open interest on the call side, usually like out of the money calls there's more open interest, and out of the money puts there's more open interest. So depending on which strikes you're using, you might want to pick one or the other, just because there's more open interest there, and more open interest could signal to you more liquidity. However, call spread is the same as a put spread in general terms. All right, so the third way we could take advantage of these things and short volatility is straight up shorting one of these ETPs. So you could go in and you could actually just go in and short TVIX. You could short 100 shares of TVIX. Now, we've discussed the risk of that is that if this goes to 100, you're going to need to absorb that. And now with TVIX trading 67, it could very easily go to 100. And I would consider, if you're trading TVIX, I would look at what happens to me if this goes to 200, because now that it's split, it's much more feasible that this thing could go to 200. TVIX doesn't have options, so you have no way of hedging yourself with options. If you were going to straight up short UVXY, though, for example, what you could do is you could hedge yourself. You could buy some calls, and so if you're for every 100 shares you're short, you could buy. No, these front week calls only protect you for a couple days. However, you could get them for dirt cheap. $1 a piece for some of these, and so if it's a Friday and you're short UVXY, why not spend $5 to protect yourself for that day? Or a Thursday even, go out and buy some out-of-the-money calls to protect yourself if you're short UVXY stock. And initially, that's the way everybody pretty much traded these ETPs, was to short the stock. But nowadays, people have gotten more sophisticated with some of these options strategies. Now, before there was the VIX, people still sold volatility when it got high by just picking an individual stock as a proxy for the market and selling options in that stock, or selling options in the SPX or other indices, the OEX maybe. These volatility products have made it easier for the public to do these things, but it was still doable the whole time before then. Anyway, I've gone a little long for right now, but I'm happy that I'm back on the air here, and I will come back on this afternoon to interact with you more in real time, because I realize I haven't done that much. Let me just go over to the chat here for a second and say hi to everybody. Hey, what's up, guys? Yeah, that channel name thing was that was my attempt at humor. Would you exit short if you had December 13 VIX puts? So you're saying if I was long some of these VXX puts, hi hubris. If I was long some of these puts, would I just bail on them right now? Possibly. I mean, if something's going really against you and it's really bugging you, my recommendation to you is to do something. If you're losing money on a position and you've taken a loss today, I would recommend that you do something. Work towards you got a problem. Do something about it. Don't just do nothing. Now, if maybe it'll turn out that it completely comes back for you or something, but you want to do something. People ask me all the time, well, I've got this position's gone against me. What should I do? And there's no real right answer, because you could say do nothing and it could come back all the way. Anything I say, it's going to turn out the wrong way, because we don't know what the market's going to do. But if something's going against you and it's hurting you, do something. One thing that's very unpopular that people ask me all the time, like a lot of times it's people that are long, like a TVIX or something, but in this case, you're long the 18 puts, it's hurting you. You've got 11 days to go on them. I can't tell you what to do. If it was me, I'd probably hang out and do nothing. But the prudent thing to do if something is going against you and hurting you is to do something. So if you're long 10 puts, maybe sell 5. If you're long 50 puts, maybe sell 25. Now, you're not going to be happy in the end, because it's going to go one way or the other, and you're going to wish you'd done either more or less. But you've got a problem. If you sell half, you cut your problem in half. And the one thing that I've learned trading that not to do, especially when you're in a situation where you're only 11 days to go, is to start like doubling down, going and buy more puts here and buy more and more and more. That is a way to just really hurt yourself. If something's going against, for me, a lot of times, if something's going against me, I'll just cut off the trade and just say, you know what, I lost on that one, reset, and move on with my life. I've learned that, like, if you can cut out your losers and just move on with your life, because a lot of times if you've got a really good winning trade, it's going to start winning for you right away, and it's going to keep winning for you. But I can't really tell you what to do in this situation. If it was me, I would probably just hang out, because we're in a spike right now, and the majority of the time, this sort of spike has just the spike is passed, and the stuff's going right back down again. Now, this could be the one that gets away, and we stay in an elevated state for longer. But a lot of times, the majority of spikes only last less than 48 hours. So I don't know how much that helps you. But the other thing you can consider doing is, if you're long the 18 puts, you could consider, instead of selling those out, you could consider selling like the 16 puts against them and turning it into a spread. That way you've taken some of your money off the table, but you still have a chance for it to come back for you. Does that make sense? So you're long the 18 puts, sell a couple of the 16s against them. The other option, of course, is to roll them out, sell out your 18 ones, but buy them in the next week out. And that way, and just keep rolling them until they work for you. I mean, they're still working. Just to roll them out. Unfortunately, when you're long the 18 puts here, you've got decay working against you. You can see the call on the other side is worth 50 cents now. So this thing stays right here, you're going to lose another 50 cents on them on top of whatever you lost today over the course of the next week if this stays right here. So that's what your risk is. Like I said, if it's bugging you, and obviously it is, or you wouldn't be writing about it, do something today. Sell two. Sell something. Do something, because you want to do something. Hey, what's up, Al? So a lot of people have been bugging me to ditch the hair again. Maybe that will bring luck back to me. Anyways, great to have you guys join me here. And like I said, I'm going to cut it short for now, but I really appreciate the show of support by everybody. Everybody check out Greg's channel, Gossip Trading. He's on every day, and good stuff. Check him out. It's a little different than me. He's much more knowledgeable about charting, and looks at trades in a different way than I do. So you're going to have to develop your own style, and it's going to be based on stuff inside you, but you can learn more about your style and how you are by checking out what other people do. So you think Al, I should shave my head, and we'll make immediate money from that? Anyway, so thank you for all the support, and I'm going to leave you for a little while. We might be back on later, but it's exciting to finally be back on, and I'm going to be very careful not to get banned again this time. Good luck to everybody. Of course, the stuff spikes and goes against me the day I come back on live. I did lose a little bit of money today. My position now is entirely out in September. So my whole thing right now is I almost don't want to look at the VIX for a month or two. Just don't even look at the VIX for a month or two, and just let stuff settle out, because I'm long the 9 strike and the 8 strike in VXX, and now it's at the 17 strike. So pretty far away from the 9 and 8 strike. However, expiration for me is 293 days out. Hey, if shaving my head will get this market to do what I wanted it to, I would do it in a minute. I don't know if that's what's going to make this market do what I want it to. So I don't know if Brent is still on here, but we want to check out Brent's stuff too. Knows a lot more than I do about the VIX, and has some proprietary indicators that help you actually really see in a deeper regard the market. So check out Brent's stuff also, and I will see you back here soon. And thank you for watching. Let's put the little closing YouTube thing on, and hopefully I don't get banned for using somebody's YouTube stuff. But who knows?
Oh my god, that lighting though. TV's on in the background, but I like this ambiance.